welcome to our YIS online club for this week. We're going to be going over Unit 5, Lesson 3, the income statement. And with me today, I have Mehul. Mehul is from Arizona. He's going to be your instructor today. He's on our student advisory board, and he's prepared a wonderful presentation for you guys. So I'm super excited for him to share that with you today.
All right, so Unit 5, Lesson 3, income statement. So I'll start off with the idea of the week. So I'm not sure if you guys saw, but GameStop stock like that, it went up like 1,300% this month. Yeah, so Wall Street bets, pump the stock and then cause a short squeeze where all the short sellers had to like buy back, cause a stock to skyrocket. And then they're targeting AMC, BlackBerry, Nokia, etc. So it's pretty interesting to see that. I've never seen it before. It's basically a statement that shows sales, profits, gross income, etc. And a company just has to submit it every 3 to 12 months, every quarter, and then it just shows up up to every 3 to 12 months. So so we're going to be going over. So income statement is also referred to as profit and loss statement, or revenue and expense statement. And so a company needs to report it quarterly, and so we're going to be going over revenue, COGS, gross income, non-direct costs, etc. And so usually the people who are reporting or creating the income statement for the company are the professional accountants, controllers, or CFOs. So let's start with revenue / sales, price of the product. The formula would be price of the product times the number of products sold. So if you have a lemonade stand and you are selling lemonade, and let's say each glass of lemonade is $1, and so you sell 5 glasses of lemonade, so that's the price of the product would be $1 times the number of products sold, which would be 5. So the revenue would be $5. Now we have cost of goods sold, and so cost of goods sold would be the cost directly associated with the product, which in the lemonade stand's case would be you have to buy the lemons to make the lemonade. So the cost of the lemons would be the cost of the goods sold. So let's say each lemon costs 50 cents, and you sell each glass of lemonade for $1. Then that would be the gross income. So revenue minus the cost of goods sold. So that'll be the glass of lemonade you sell subtracted by the lemon you use to create the glass of lemonade. So then we have non-direct costs, which is like costs like not associated with the actual product. Like, so let's say you want to market your lemonade stand. You would buy a sign to put up front to just tell people that you have a lemonade stand here. So that would be marketing, and that would be a non-direct cost of the product. So let's say the stand costs 25 cents, and that would be your SG&A's costs, selling, general, and admissions costs. So you have your operating income, which is also called EBIT, and to calculate this, you need gross income minus SG&A. Which would equal operating income. So you know that the gross income was the revenue minus the cost of goods sold. So that would equal the gross income, which we found out to be 50 cents, and then minus the selling, general, and admissions costs. And so we're using the sign. So the sign we put up front would have costed 25 cents. So it'd be 50 cents minus 25 cents, and the operating income would be 25 cents. So then we got EBITDA. So that's just the depreciation cost. So like, let's say you just have cash sitting there, and the cash every year is depreciating from inflation. That's what this would go under. So, interest expense. So you borrow money, pay interest on it, and that would be your interest expense. And then finally, we get to net income. So after you deduct all your costs from the operating income, you have to subtract taxes, and finally you get your net income, which is what the company posts. So yeah, let's quickly analyze this. So you have net sales, which would be revenue, which was for Apple was $42 billion, and then cost of sales, which would be the cost of goods sold. So how much it costed how much the components of, let's say, an iPad costs for Apple. So that was 26 billion, and finally you get your gross income, which was 16 billion. So you have revenue minus cost of goods sold is equal to a gross income. And now we go to your operating expenses, which is again the non-direct, the costs that aren't associated directly with the product. So you have like something like research and development, then selling, general and administrative costs. And so in total, those would equal the total operating costs. And after you subtract the gross income from the total operating costs, you get the operating income, which would be 11 billion. And you have to subtract taxes, and after everything, your final net income would be 8 billion. So here's some questions we should discuss. So why is the income statement so important?
Well, I mean, it kind of gives out how the company's doing the revenue, per quarter or also yearly, right? And
Yeah,
it also
so
tells you how much it's like, what the expenses are. So
yeah, so you can see it grow, how it's growing.
yeah.
So which two lines on the income statement do you think are the most important?
Net income and cost of goods sold.
Yeah. I think that's. So yeah, this is the video on income statements.
The next item of financial statements to go through is the income statement. And the income statement is the statement which shows how much revenue, how much sales during a period, during a 3-month period or 12-month period, you're able to generate in terms of sales, expenses, and profits. So let's watch a quick video by Wall Street Survivor talking about the income statement.
What is an income statement? Presented by WallStreetSurvivor.com. An income statement shows the financial performance of a company for a given time period. It shows a company's revenue and costs and is therefore a pretty good indication of the strength of the company. Income statements are also called profit and loss or P&L statements or revenue and expense statements. Income statements are prepared as a part of a company's financials. All public companies are required to submit them quarterly, regulated by the SEC. So let's look at a simple income statement in practice. Here's Mary. Mary owns her own successful flower shop, Petals, and has begun filing her income statements for the quarter. Last quarter, Mary sold $500,000 worth of flowers. This is her top line revenue. Revenue is also sometimes called sales. Next, Mary needs to add up all the costs directly associated with cultivating her flowers. These costs include things like seeds, earth, fertilizer, and electricity. These are added together and are collectively known as costs of goods sold, or COGS. Revenue minus COGS is known as gross income. Think of this as money made from both growing and selling flowers. After that, Mary adds up her non-direct costs. These are costs she incurs that aren't related to sales. Petals' costs included marketing, rent, and salaries to her 2 store managers. These costs are known as selling, general, and administrative costs, or SG&As, and are often thought of as the company's overhead. Gross income minus SG&As is referred to as operating income, or income earned from a company's operations. Lastly, Mary subtracts taxes from her operating income to get her net income. Mary now has a good understanding of the profit generated from Petals. Usually, income statements are a little more complex to put together and are handled by professional accountants, controllers, or CFOs, and follow the general accepted accounting principles. To learn more about income statements and other topics, head over to WallStreetSurvivor.com.
All right, welcome back. The income statement is perhaps one of the key financial statements that we need to understand, and a lot of the forecasts that we do for our companies are based around the line items in the income statement. So the first one at the very top is the revenues, and the revenues or the sales are how much this company is generating in terms of gross sales. We calculate sales by the amount of products it sells multiplied by the price that it sells that item. So sales, we can see this either growing or declining over time. The next item is the cost of goods sold. Now the cost of goods sold is the cost that it takes to sell those items. So if we're Apple in this example, the sales are the total amount of gross revenues that they get from selling, let's say, computers and iPhones. But the cost of goods sold is the total cost of all the components that they took to put that together to sell those items. After that, we are left with the gross profit. So how much do we sell it for? $100. How much did it cost? $80. The gross profit is $20 in that device. And then we would multiply that by how many devices that we sold. After gross profit, we have a couple of expense items. So we have, in this case, research and development costs. That's how much Apple is paying its research and development team to continue to innovate new products. We have operating expenses, which can include normal personnel expenses, general and administrative expenses. These are your headquarters costs and your headquarter employee costs. We also have your marketing costs. So all of your individual expense line items come there below gross profit until we're left with operating profit. Your operating profit is your profit after all of your normal business expenses. This may be referred to as EBIT in many financial news sites. Another item related to EBIT is EBITDA. And so you'll hear analysts talk about EBITDA. EBITDA is your operating income, your EBIT, added your depreciation costs. And the reason why you would add your depreciation costs is because this is a cost which is stretched out over time. And so EBITDA is often used as a proxy for how much cash earnings that business generated that year. Below EBIT, we have interest expense, and that's how much interest expense you pay on debt. You have income tax expense, that's how much tax you have to pay. And then finally, after all of our expenses, we're left with net profit. And these are our earnings, these are our profits, which we've talked about. And ideally, stocks follow earnings, and we want to invest in companies that have growing profits. This may be through growing revenues, but it also may be through growing profit margins. And below that, we look at earnings per share. So if you take the profit divided by the shares outstanding, then we're left with earnings per share. So I hope that explains one of the key financial statements, which is the income statement. And we have these key line items to understand. If you have any questions, research it at Investopedia or other websites. Thanks so much.
Yeah, so that was that video, and
how does financial ratio analysis work? Let's discuss 10 of the most popular financial ratios that can help you find the story behind the numbers. What do you need to get started on a financial ratio analysis? You need an income statement, the overview of how much profit a company made during a year. You also need a balance sheet, an overview of what a company owns and what a company owes at a specific point in time. We will start off with financial ratios that only focus on the income statement, then look at financial ratios that only focus on the balance sheet, and end with powerful financial ratios that combine information from the income statement and the balance sheet. Performing a financial ratio analysis has a scientific element to it, finding data and putting it into formulas, as well as an artistic element, assigning meaning to the outcome of the calculations and seeing the big picture. Part 1. Financial ratios that only focus on the income statement or profit and loss statement, P&L. Let's compare the income statements of two fictitious companies, which, unlike real-life companies, have nice round numbers in their financial statements. The first step in financial ratio analysis of the income statement is to make everything relative. relative to sales, that is. Each of the cost line items and profit subtotals is expressed as a percentage of revenue. Let's see what the financial ratios tell us. Company A has a gross profit margin of 50%, Company B of 30%. So the gross profit margin is 20 percentage points higher for Company A. Company A makes far more margin than Company B on the products or services it sells. Company A has an operating margin of 21%, while Company B has an operating margin of 14%. So the 20 percentage points difference, 50% versus 30%, on the gross profit level has shrunk to 7 percentage points, 21% versus 14%, on the operating margin level. Net income as a percentage of sales, often called return on sales, is 16% for Company A and 8% for Company B. What do we zoom in on for further analysis? Let's investigate the difference between gross profit and operating margin. This is mainly driven by selling, general and administrative expenses. 20% of revenue in Company A, 10% of revenue in Company B. The non-manufacturing costs for functional departments like sales, marketing, finance, HR, sourcing, legal, and IT are far higher for Company A than for Company B. This could be related to the industry each company is in, the company's strategy, or the level of efficiency that it has achieved. Could Company A be overspending in SG&A, or is Company B underspending? Hard to say just from these numbers, but worth investigating. On the research and development line, Company A is spending more than Company B. This is usually seen as a good thing, as today's research and development expenses hopefully lead to high-margin, innovative products and services to sell in the future. Part 2. Financial ratios that only focus on the balance sheet. The first question that I always ask myself is, how is the company doing on liquidity? Is it likely to be able to pay its bills in the short term? Let's look at the current assets, cash plus items that are likely to convert to cash within a year, versus the current liabilities, items that need to be paid with cash within a year. A useful financial ratio in this area is the current ratio. Simply divide the current assets by the current liabilities. For Company A, 400 divided by 200 is 2. For every dollar of current liabilities, there are $2 of current assets, a safe position from the perspective of business continuity. For Company B, 200 divided by 400 is 0.5. For every dollar of current liabilities, there's only 50 cents of current assets, a more risky position for a supplier that is hoping to get paid. While on the topic of current assets and current liabilities, let's calculate the amount of working capital utilized by the companies. Accounts receivable plus inventories minus accounts payable. For Company A, this is 150 plus 200 minus 200, in total 150. For Company B, this is 50 plus 100 minus 300, in total negative 150. Company B seems to be getting paid by customers before they have to pay suppliers and holds a low level of stock. The next financial ratio is all about the company's financing strategy. Does it primarily borrow money to finance operations or rely on capital provided by the shareholders? The debt to equity ratio can help you put that in perspective. For Company A, 100 in borrowings, 700 in equity. So a debt to equity ratio of 1 to 7. You could call this a conservative and robust way of financing. With a big buffer of equity, it helps defend the business continuity of the company in case of future losses. For Company B, 400 in borrowings, 100 in equity. So a debt to equity ratio of 4 to 1. For every dollar of shareholder capital, equity, there are $4 borrowed, which is possibly more fragile. A related financial ratio is equity as percentage of the balance sheet total. 70% for Company A, 12.5% for Company B. Based on the debt to equity ratio and equity as percentage of total, you could say that Company A has low leverage, while company B has a high leverage. Part 3. Financial ratios that combine information from the income statement and the balance sheet. This is where you might see new storylines and connections, on top of what you discovered in analyzing the income statement individually and the balance sheet individually. Let's start with a big picture financial ratio called return on equity, which is net income divided by equity. For company A, 160 divided by 700, which is 22.9%. For company B, 80 divided by 100, which is 80%. On the return on equity metric, company B far outperformed company A. What is driving that? While company A has higher profit margins, as we saw in the income statement analysis, company B has a much higher financial leverage, as we saw in the balance sheet analysis. There is a third component to the return on equity calculation, the financial ratio called asset turnover. Asset turnover looks at how much revenue is generated by the company with the assets it has. For company A, asset turnover is 1. 1,000 in assets on the balance sheet generates 1,000 in revenue in the income statement. For company B, asset turnover is 1.25. Let's dig a little deeper into two key subsets of this asset turnover ratio. The first one is receivables turnover, the number of times per year that the business collects its average accounts receivable, the ratio between revenue in the income statement and accounts receivable on the balance sheet. 6.67 for company A, 20 for company B. Receivables turnover might be a bit abstract for a lot of people, so let's turn it into a more tangible related metric called days sales outstanding. How many days does a company need to wait before a customer pays? 55 days for company A and just 18 days for company B. The second subset of the asset turnover ratio is inventory turnover, the number of times per year that the business turns its inventory, the ratio between revenue in the income statement and inventory on the balance sheet. 5 inventory turns for company A, 10 inventory turns for company B. So what do financial ratios tell us? Can we say, based on calculating these financial ratios, that company A is in better financial shape or company B is in better financial shape? Not necessarily. Financial ratios do provide us with clear information about the financial footprint of a company and deepen your understanding of the strategic and operational story behind the financial numbers. In this video on financial ratio analysis, we covered 10 financial ratios. On the income statement, gross profit percentage, operating margin percentage, return on sales percentage. On the balance sheet, current ratio, debt to equity, equity as percentage of total. When linking the P&L and the balance sheet, return on equity, asset turnover, receivables turnover, inventory turnover. Financial ratio analysis is as much an art as it is a science. Want to learn more about business, finance, and accounting? Then subscribe.
Yeah, so that's financial ratios. So after watching that, what do financial ratios help us to do? Oh, okay.
I mean, it kind of just evaluates how the company is doing when it comes to performance,
Yeah.
like by analyzing the balance sheet and right.
Yeah. So value and comparing.
It also kind of lets us compare against other companies in the same industry.
Yeah, exactly. Yeah. So these are basically the formulas for financial ratios. We have the current ratio, which is the current assets over current liabilities. Working capital, accounts receivable plus inventories minus accounts payable, and then it just goes so on. Working capital is more of like used to try to define. Working capital is used to define the efficiency, and so is asset turnover. While debt to equity ratio and equity as percentage of total is more of used to see how leveraged the company is. Yeah, so those are the formulas. If you want, you could take a screenshot. But yeah, so if no one has any questions, I have 3 questions set up. So, yeah, okay. So question 1: if Tom's business had a gross income of $1,000 and a SG&A of $750, what is his operating income?
B.
Yeah, correct. Question 2: what is one example of a non-direct / SG&A cost?
Would research and development count on this?
Yeah. And then finally, if current assets equal $1,000 and current liabilities equal $500, what is the current ratio?
Is the answer 2?
Yeah, I'm pretty sure. Yeah, it's 2. Yeah, so that's all I have for you guys today. If there are any questions, then I guess we're done. So yeah, are there any questions?
No, looks like everyone's good, Michael. Thank you
Okay.
so much for preparing that presentation today. Really appreciate it. I thought it was really good information. I loved the videos. I think they were clear and concise. So thank you for that. And until next week. So next week we actually have Rebecca Bonds. She is a regional advisory board member. And she currently lives in Canada, and she's going to be joining us, and she's going to talk about impact investing and how that's different from ESG investing. So that should be a really good discussion next week. So until next week, you guys, same time, same place.